Interest in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hey, listener. This is season number 6, episode number 3 coming at you. I have a guest today, Miss Lauren Wells, that's going to be on from 70 Investments. She got a nice little background, been in the business for a little bit, and definitely is making waves and has a lot of experience on the subject of note investing and other things related to real estate. So you guys are going to enjoy this episode. So stay tuned. Well, hello, Lauren. It is a pleasure to meet you.
Thanks, Justin. Thanks for having me today. Excited to be here.
You're welcome. This is the first time I'm actually meeting you, over the internet or anything. I don't think we've ever been at a conference at the same time in the real estate / note world. So yeah, this is our first time.
Yeah. I used to go to all those conferences, but now my role has shifted a little bit. So I'm on to a different set of conferences.
Yeah, I bet. So speaking of the different set of conferences that you go to, I'd like to kind of give the audience a background on who you are and kind of how you came to found the 70 Investments company with Chris.
Yeah. You want to go ahead and dive into it?
I mean, you don't have to go all the way back from birth, but you could go back, at least several years and kind of what you did in the W2. There's some air quotes here, W2 world until you got to today.
Definitely. So I don't know kind of who your listeners are, but I'm going to just imagine that maybe some of them listening might be people who have W2 jobs.
There's only 3 of them, so I could probably name them for you.
You, me, and one other person. The person
and Chris.
The editor.
Chris is the other one, yeah.
So, I was essentially a listener who had a W2 job and was thinking about all the ways to get out of my W2 job and that buzzword of passive income and how do I get there? And I'm a big networker. I am involved in a lot of real estate groups or I was at the time. So how do I, was networking with people, see what other people were doing.
Yeah.
And mortgage notes appealed to me because I live in California and I wasn't really too keen on investing in property out of state. And California is a big pay to play if you want to, get into the rental market. So I was like, well, I can do mortgage notes. I'm okay with that outside of California. And then I don't have to manage the property. I'm becoming the bank. Like you said, be the bank.
Yeah.
So I got into that. I started with second position mortgage notes. I found a mentor in the space who did seconds and learned all about how to look and analyze a tape, the due diligence process, did a lot of free work for him learning. And then I heard Chris speak at a conference, a virtual conference. And I, loved everything he said. I think his topic of his presentation was like how you're going to lose all your money in note investing. And I was like, this is what I need to know. Risk mitigation. Great. And I basically reached out to him on LinkedIn and said, hey, enjoyed your conversation. I would love to grab coffee. Well, he ignored virtual coffee. He ignored me. He reached out like 2 or 3 more times. It was like, I'm kind of persistent like that.
Yeah.
And a mutual connection of ours was like, hey, she's not crazy. You should probably connect with her. So we connected and we did a ton of just kind of coffee conversations where I would ask him a ton of questions about, I was trying to navigate the jump from second position to first position.
Okay.
Mortgage notes. And so that's what he did. And so I learned a ton there. And eventually he asked me to help manage his help him manage his other funds. So I helped on the asset management side. And then we kind of formed this we did about 2 years ago now, launched a larger fund, 2 larger funds rather, together, and kind of divide and conquered the business into the acquisitions and asset management, and then me overseeing capital raising and investor relations and operations. So that's kind of where we're at today.
Wow. So you stalked Chris to get a job. That's what I heard.
I talked to Chris to learn, and it somehow ended up that we're now business partners in this wild adventure.
He talks very highly of you, just so you know. So he commends you on all the stuff that you've done, and gives you a lot of credit for making the company the way that it is today. So just want to make sure you get your props there.
Oh wow, well, I think it's a yin and yang is what we are, and so our strengths play off of each other, and so it works.
Yeah, I always tell people when they first get started in this business, if you want to have a note business, you really need to have a partner with you. It's really challenging to do this by yourself because there's just too many things to do, and you just need the help. And exactly what you said, which is why Richard Thornton and I, we had partnered together until he retired recently. And that was the yin yang. He was not detailed at all. he left that stuff to me. And I was like, okay, I feel comfortable with that. I'll do more detailed stuff. And then he handled more the investor relations and raising capital and stuff.
Yeah.
So, but now he left me with a bat in my hand. Now I got to figure out how to do this stuff. So you're on the show today to teach me.
There you go.
Yeah, just kidding. So when you got into mortgage note investing, did you also have experience like in real estate investing, like flipping houses or commercial deals? Or
yeah, great question. So before the show, we were talking about our kids, and I'm the oldest of 3 girls, and I grew up around real estate. My dad he sold real estate. So sold real estate. And then he started, when I left for college, got into, his own buy and holds, and kind of grew his real estate portfolio. Me being the oldest, and I see this in my oldest now, you tell them one thing and they're going to do the opposite.
Oh yeah.
So I think that just followed me, and I was like, I'm not doing real estate. I'm going to go and I'm going to do that like Silicon Valley life. I'm going to work at the startups, go through the IPO. And I did that. And I, found my kind of niche in business development.
Okay.
And I loved it. But I realized, light bulb went off, and I was like, shoot, maybe my dad was onto something about, having this freedom if you're investing in assets that pay you. Yeah. And so I kind of went back and that's kind of where my, I guess you could say, research journey began into what different asset class do I want to go into, and how do I want to build my own portfolio with starting with my own capital.
So do you like seconds or first better now that you've done both?
Well, right now I like first better.
Yeah.
When I was doing seconds, it was, the coverage was insane. You weren't really going to have to worry about being underwater. Right now, seconds wouldn't be something I'd want to really be in second position.
Yeah.
First, I like first better, just to answer shortly. Yeah.
Yeah. And did you ever get into seller finance paper, or you mainly tried to?
I looked into it. It was one of, so, you decide on mortgage notes. Yeah. And then within that, there's first, there's seconds, there's seller finance, and there's all these different kind of experts in the space. So I remember reading a lot that Fred and Tracy would put out about seller finance, because they're kind of the go-to in that space, right?
Yeah.
So I looked into it, and at the time I was like, to do this well, I need to be like in sales mode. I need to be finding and sourcing. And I was like, I was a new mom of 2 at the time. And I was like, I don't have the bandwidth to do that right now.
Yeah.
Like, so I stayed in seconds and then moved into first.
Okay.
Yeah.
So when you are working with potential investors that can get into your fund and you're raising the capital, are you educating them on the general aspects of like note investing, not really getting into specifics of first and seconds, or like how do you approach that with education?
Yeah, great question. So what I've learned is there's a big emphasis on education that Chris and I have. You go to our website, we have webinar upon webinar upon webinar of what we do, who we are, how mortgage notes works. And even though to you and I, it might sound super simple and like we're repeating ourselves constantly, mortgage notes is not something people are talking about. It's not like the most known about asset class. And so what we say and how we've broken it down is kind of comparing it to fixing and flipping homes. So we say we fix and flip mortgage notes. Okay. That's kind of like how it resonates with people. So how do we get people who want passive income, want to invest in real estate, don't want to do it on their own, and maybe I heard a little bit about mortgage notes, or somehow, they ran across Chris on Bigger Pockets.
Yeah.
How do we get them to understand what we do and why we do it well? And so again, a big emphasis has come across. We don't really break into first and seconds because we really primarily focus on first for our funds, but really walking through what due diligence looks like, what are the investors' concerns, and kind of trying to answer those while also educating them. So risk, what's the risk profile of mortgage notes in today's economy? How big is this market? So educating them over and over, again, we do like monthly webinars at this point, and we've gotten a lot of great feedback on that because people want to know at some level, they want to understand what they're investing in.
Yeah.
So, yeah.
They want to know how it works, but they don't want to go out and do it.
Correct.
Like before I buy this pack of bubble gum, I want to see how it's made, see what's in it. Okay. I'm not going to go get a factory and make it. I'm just going to go buy it from that's already ready for me.
Yeah. Or like you probably know, we do have people who think they want to build the factory and then they get into it and they're like, actually, no, here, I'm going to invest with you. This is way more work than I thought.
Oh, I didn't know it was going to be a job.
Yeah.
I didn't know that.
I didn't know that getting into it. So
passive income sometimes is not as passive as you want it to be, unless you are on the investor side, like investing in a fund that we both have. That's I think is the trick that people don't understand. Even being a landlord, as you know, personally being a landlord, and I reluctantly had some rentals. It's not passive income by any means. It's hard work, especially if you don't have things well oiled in your operations, which is why business development, the skill set that you mentioned earlier, I think is so vital for an operation, because you have to treat it as a business. Everything in its core function is a business, no matter what you're doing in real estate. And I see a lot of investors kind of fail at that aspect, and they don't understand the financials of how to run a business and things like that. They're just like, I'm really good at wholesaling, so I'm just going to make a business out of it. And it's like, you look at their books and you're like, what is going on here? How are you making money? Like, there's no way you're making money, Yeah. It's kind of funny, but, so education is great. I think that is the perfect way to start the conversation, because everything I feel like from investors from the first time, this is like taboo to them. Like, it's like, oh, I've heard of seller financing, but if they don't see a large influx of cash, they assume that that's not really a profitable investment. They're not looking at it as, this is your retirement money. This is something you're building towards. This isn't like you're going to go flip a house and make $100K in California during the heyday, at any given moment, and have this influx of cash and become an overnight success. That's not what this is,
And I think that's such an important point that you touch upon, because right now, if you look at any of the, I don't know, if people are listening are on Bigger Pocket forums, or, I'm part of a ton of investor communities. Yeah. And the common theme is capital calls, distributions are being paused, or syndications that have gone completely under. Yeah. And part of me, I could write a whole LinkedIn post about this, feels bad. And I do empathize with these people because it sucks to lose. But also, like you just mentioned, the last pre-2022, the decade prior to that, you could place money probably anywhere and win.
Yeah.
So due diligence, I feel like the due diligence people put into not just the asset class, but also the sponsor just dropped. I call it yield chasing. Yeah. So like, what's going to give me the highest return? And it worked. People made a lot of money. Yeah. However, we are not in that economic environment anymore. So the investors that you're speaking to, another part of like what we focus on, and this helps us maybe, but also might not, depending on the investor's risk profile.
Yeah.
Is educating them on questions they should be asking.
Yeah.
When you're talking to a sponsor, what they do is important, but their track record, their time in the business, their communication and transparency is also of utmost importance. So I think that's something that we focus a lot on as well, because just how do we empower our investors or potential investors to safeguard their, their capital?
Yeah, it feels like today, because I've been paying attention to it a lot more the last 6 months than I ever have, with posers in our industry, and especially multifamily, because of the challenges that they're going through. And they make it seem like it is just pouring gold out there right now. And I just feel really bad for the investor that just doesn't really, that's buying into the sales tactics and not really divesting their time into understanding the sponsor and their education behind it. A couple of these people I actually know personally in the multifamily space. And I'm seeing this stuff on LinkedIn just so that everyone listening out there knows what I'm seeing out there. But that's where I see the most like advertisement and push. And I think it's more the players in the multifamily space, because they're desperate right now.
Yeah.
They're desperate for raising capital. They're desperate to find deals. They're desperate to get capital raised so that they, like you mentioned before, because of pausing distributions and because of, asking investors, can you please put more money in? And, oh, by the way, I'm not going to be able to distribute any proceeds to you next quarter, for this, that, and the other. And I do feel bad for the investor as well out there, but they do have some challenging stuff in front of them. And because of all this uncertainty, they might not know where to put their money, which is probably why the self-directed IRA companies' cash on hand continues to rise. And I want to say it's probably getting up to the hundreds of billions of dollars by now. I'm sure with all the IRA companies combined. I don't know if it's the $1 trillion number yet, but it's up there.
It's probably creeping up there. I mean, I'd imagine, but yeah, I mean, you're probably seeing the same things I'm seeing. And as someone in business development, and I guess you could say sales, it like kind of makes me cringe when I see some of these things. I'm, because I can see, you can see, like, okay, clearly look at this guy's background. Did he start 5 years ago? What has he done? Or, a common thing I'm seeing is, and Chris and I have talked about this at length, is, and it drives us nuts, is you have a debt fund all of a sudden, like a multifamily, development fund is like, oh, we have this debt fund, but the debt fund is needed to help make sure that their other investors in their development fund don't, take a huge hit. So kind of like, what does that mean for, like, where are people falling in the capital stack? Is it really a debt fund? Is it dressed up as a capital call? So how do you, I guess, I feel like we could probably do a whole, series on how do you spot like fraudsters, because I don't think
the classic rob Peter to pay Paul. But they're shifting money around because the government isn't printing them money. They're getting money from the consumer, and the consumer's wanting the product that they're offering. So I don't know the exact details of your guys' fund. I'm sure it's very similar to what we do. But when Richard and I started the fund, we said, what are the things that people are looking for? They're looking for short-term, which, 1 to 2 years, we'll say short-term. Mm-hmm. They're looking for a complete passivity, and they're looking for a lot of security in what they're doing, and they don't want it complex. And so we said, okay, we'll have a true debt fund. We're borrowing money from the investors and we're paying it back. And that's just it. Keep it very simple. There's no waterfall distribution. There's just, the asset class we're going against is a lot lower risk than, building a multifamily unit that's just going to go vacant.
Yeah.
So,
yeah. And I think it's hard because how do you explain, I guess, I don't know if this is a good analogy, but I kind of came up with it and we're going to tweak it until it gets right.
All right.
But I feel like
here we go.
So do you know what Foster Freeze is? I think they have that everywhere. It's like the ice cream, the classic vanilla ice cream cone.
Is that the brand name of the company?
The company is called Foster Freeze.
I haven't heard of it, no.
Okay, so
I'm a Hoosier, okay? We don't get much things.
I feel like they're everywhere.
East of the Mississippi.
They were like somebody listening will know what Foster Freeze is. But
they probably will, yeah. I'll be the only one.
vanilla ice cream, and you could get it dipped in chocolate if you wanted. That was like as fancy as it got.
Okay.
So I feel like mortgage notes and the way our fund, and I don't know much about how your fund is structured other than what you just said, are very much that like classic, stable, you know what you're going to get. There's nothing fancy. We're not saying we're promising 20% returns.
Yeah.
But, we're going to hit doubles and triples, maybe a home run every now and then. But like our goal is that consistent income for our investors. And I feel like these funds in the last, decade that have come out, I'm not trying to pick on multifamily, but it's what I'm seeing right now. So I'm just going to go there, or opportunity zones or oil and gas. It's like, hey, we can promise all these crazy, awesome things. And we'll give you all these high returns. And I kind of feel like they're like the cold stone, like sounds good, might be good, might also make me completely sick. So do I want to stick with the like basic? So I feel like you kind of have, everyone should have some cold stone in their portfolio, but right now it's how do you keep your money?
Yeah.
How do you not lose money?
Yeah. I like that. Your baseball analogy is great. We're just trying to get singles, to be honest with you. We're just, when I'm not sure how old you are. I'm assuming you're younger than me. And so when I was growing up, it was always like when you get your paycheck, you put 10% aside, after you've already put money into your 401k and your company has matched it and whatnot. And so the company's 401k manager would just go out there and just make sure that the funds out there were just returning you like 6-7%, like clockwork all day long, very low risk stuff. And I feel like that's what the investor should focus on right now with the uncertainty going on is, if you feel like there's an opportunity to make a bunch of money, you should be actively going after it. If you're trying to make active money and be passive in it, that's the recipe for disaster. Because I think that's when they get caught with those yield goggles on and they're trying to get those big returns and be like, wait a minute, I didn't get paid last year. What's going on here? And hopefully investors are just realizing that, they need to do real estate CDs is what I call them. That's what our funds are, they're low risk. They're just constantly churning you money. They're not going to make you, 30% or anything like that, but it's just going to make you grow. And the risk of you losing your money is significantly lower. Yeah,
I agree.
Yeah. So what is the typical, what do I want to say? I don't know if lead time is the right word, but what is the typical, I guess, lead time for an investor that just figures out like, hey, this mortgage note investing and 70 Investments is having a webinar and stuff. Like typically, when do they start getting curious to be like, I'm ready to make a decision on if this is the investment for me or not?
Yeah, I think it just depends on where they're at in their overall investment journey. We've had people, and then what type of investor they are.
Okay, that's fair.
Yeah. So like, are they, a W-2 employee who's like, hey, I should probably look into passive income options. Real estate sounds good. And they come across, mortgage notes and us. That's probably a lot longer of a play. It is a lot longer of, they might be on our email list watching webinars in the background for 6 months to a year.
Yeah.
Whereas someone who's pretty savvy might have a self-directed IRA and just might be looking for options. That could be a quick, 1-2 months. And then as far as like, we've had investors who have been on our email list for 6 months and then they'll drop, say, 100K and we're like, we've never talked to you. Again, we have a Reg A, so it's allowed. I'm not we're not breaking any rules.
Right.
But, and then we have investors who will be on our, list for a month, but then they need to talk to us probably 5 or 6 more times before they're ready to invest. So it's definitely runs the spectrum of like, how long have they been looking at an alternative investment and what's their investment knowledge? And then really how comfortable are they with Chris and I, and the team?
That's a good point. I agree with everything you said. That's been my experience as well. And the people that end up pulling the trigger the quickest are the ones that have the most disposable income. Yep. Because I feel like they've already educated themselves in the space. And if they stumble across one of us, it's like, okay, once I'm comfortable with the sponsor, then I'm ready to go.
Yeah. Yeah. And I think that's something that's we've seen a lot of success with, and I don't know about you, but is for our retail investors, at least, they really want to know who are Chris, and Lauren? What is their background? Why should I trust them? And like our backstory, even, we just did a webinar this month, it's January, right? Yeah. This month about, our backstory, our whole backstory of why we launched this specific fund, this offering, how we met, how we got into mortgage notes, and our backgrounds and our, kind of paths to mortgage notes are yin and yang. So we received a ton of great feedback on that, because
Awesome.
I think once they get to trust you, then you can talk about the details of your fund. But if they don't get a good sense of, I feel like this person is going to do right by us, good times and bad, if, they're going to communicate, then talking to them about the details, no matter how great your offering is, isn't really going to sit with them until they've bought into you as a person and a sponsor.
Yeah, it makes total sense. I think there's too many salesy people out there that are just trying to herd cattle through their operations and see how much money they can pull from that herd. And you guys approach it the same way that I do, and I'm glad that you do, which is obviously why you guys are very successful, because you guys are doing it in much greater volume. Is everyone on that call is my friend? It sounds kind of easy, but they're my friend. I mean, I talk to them as if they're my friend. I joke around with them and stuff, and then we finally get to whatever it is that I do or however I can help them. It's always like a help. How can I help you, or how can I pass along knowledge to you? And then sometimes the byproduct is I get an investor in the fund, and sometimes it's just, hey, maybe down the road there's an opportunity where they can create a note and I can help them, or I can buy that note from them and stuff. So yeah, I fully agree. It's, I don't like being salesy in general. I feel like I'm not a salesman, even though I'm supposed to be a salesperson. I just want to be their friend, Lauren. So, all right. So 70 investments, you guys have been open for two or 3 years?
Yeah. So 70 has been around for just under a decade. These two offerings that are bigger
right.
have been around for since almost 2 years now, almost exactly 2 years.
And what are the two types of funds?
Yeah.
You said one's a Reg A, but
yeah. So we started with the Regulation A offering, which for people who are listening may or may not know, it essentially is, think of like crowdfunding for real estate. So we can market to anyone. We can accept funds from accredited and non-accredited investors. And there's a low, barrier to entry. So our goal there, when Chris and I, something you said earlier was like, when you and your business partner were creating a fund, what do investors want? Yeah. So when Chris and I created this fund, it was what did we want? Because I wasn't accredited when I first started in notes. So what do we want? What did we wish we had access to at the time when we got into notes? And so we wanted something that was accessible and available to everyone. So low minimum, available to non-accredited investors. And so that's the Reg A, and that's really, taken off. Then we also launched the Reg D, which is 506C, and they run alongside each other and invest in the same portfolio of assets. They're just kind of two different ways to get into the same fund.
Okay. So you have a Reg A and a Reg D, and they both are the 75 million each?
Yeah. So it's 150 million between the two, 75 each.
Okay. Very cool. So I was going to ask you something else now. It wasn't related to the investor stuff. It was, I asked a friend of mine last time I had him on the podcast, I think his name was Jay. And I asked him I asked Richard. That's what it was. Last season, I asked Richard, what was his most favorite thing about real estate investing over his whole career? And he'd been doing it 35 plus years and stuff. So out of your career so far, what's been your most favorite thing that you've liked about real estate investing? And Richard's answer was a surprise to me, because it was the same as mine, even though we both don't do it anymore.
Oh, no.
So I'll let you go first. Know. Yeah.
So my favorite thing about real estate investing, I think it's just the ability to be creative. And for me, it's the impact too. I'm looking at it now from the fund perspective, not like the individual perspective. But for me, this Reg A, getting emails from investors who are able to retire, that to me is the most and maybe that's a very woman answer of me. Like, I'm sure Chris would have a very different answer. But for me, this journey along the Reg A and making this accessible to people has really been like, it started out as a passion project, and it still is, and it's super fulfilling and something I get a lot out of. And it's funny because it's not what probably most people would say, where it's like, I love the passive income. I love the ability to work from anywhere and whatnot. For me, that is all great, but I really love seeing how, I guess, we can provide that opportunity to other people. That's been kind of one of my highlights so far.
So I giggled before I asked you that question because Richard and I both absolutely love the design part of flipping a house, but at the same time we hate it. So that's been the most fun for me, was I got to have a clean slate, and then I got to redesign around it. And I always thought that was kind of fun and neat. I was not making money doing that, which is why I'm not doing it today, but it was just fun. What I like about the note business that keeps me intrigued on it is no two notes are the same.
Yeah.
And when you go and evaluate a deal, you look at it, and I just laugh because I am one of those people that's still very analytical. But when I started out, I am no different than any other engineer that comes into the space, to where they look at it and be like, how do I throw it in a spreadsheet and it spits out a number so I have my answer?
Yes.
I'll be like, it doesn't work that way, buddy. You got to have your 6-shooter to your hip. You got to be ready to gunsling a little bit. You got to have it. It's an art. It's a science. There is math to it, but you have to blend a bunch of things together, and there's emotion involved in it. And there's another, a borrower is, its own character. It's just, to me, it's just fascinating. And so I don't think there'll ever be market price for something. I think you just have to look at a ton of different things, and then what your capital stack on what you're spending.
Yeah.
And then what do you need? Most of us are borrowing or leveraging money in order to get some of these deals to do them in mass volume. So obviously we have to be wary of, underlying debt. But that's what I think is fun about the note space, is that it's so unique. It's so different every time I look at a deal that I just laugh when somebody says, oh yeah, here, I'm just looking for a 12% return. Okay. That's your goal, is to get a 12% return. Like, I'm sorry, but it's like, there's a lot more to it than that. Like, there's risk involved. Like, most of the time when people want to make that big return, they don't understand that there's going to be some hair on that deal, especially if it's a performing asset and they want to get a high double-digit return. It's like, okay, you might get 10 payments this year, but okay, if they maybe make 12, then you'll get that return, but you're lucky to get that far. So anyways, this is kind of my take on what's
when
fun.
It comes to notes specifically, I think that's something that Chris and I talk about. It's like, and we talk about when on our webinars, it's like, there's no one way, no two notes, like you said, no two notes are the same. And it allows you to be super creative, especially because we're getting these at a discount in our case. So, to be super creative, Chris definitely would do exactly what you would do, throw it in that spreadsheet. But there's also, like you said, that human element of it, because you are working with people in their different situations, and kind of having to blend the analytical and the emotional side of it to, make the best decision.
Yeah, it's if you haven't been well educated in this space and haven't seen a lot of different types of deals, from seller finance to conventional loans, like to see the different types of borrowers and situations of, low value properties versus high value properties, and you whale it in there. I have a deal I've been trying to sell in one of our portfolios forever. There's nothing wrong with it. I'm just trying to liquidate the LLC that it's in, and it's in bankruptcy. And I've had it since it's been in bankruptcy. And there's absolutely nothing wrong with it. But I think because the word BK is on there, and it's kind of a lower value asset, that people are really afraid to do it. But it's been paying like clockwork for 28 months in a row, like not even a blip on the radar. And even one of the borrowers passed away as well, and they're still making the payments. And it's not even, and there's obviously a principal balance on the back end, as well as a bonus kicker, that somebody would get, whenever they sell the house or they refi it in the future. And I just laugh and go, I don't understand why nobody wants this deal, and I even have it at a very high yield. But it all comes down to their perception of what's going on.
Yeah. I purchased one that was in BK, and they were making consistent payments and then some to get caught up through the BK, system. And so, but yeah, for people who aren't familiar with kind of how a bankruptcy works and at what different stages, it would probably seem like a bad asset, even if it is paying and you're making money on it.
It's true. Lauren, how do we get a hold of you if we want to ask you some more questions?
Yeah. I always say email me directly. You can find me on LinkedIn, Lauren Wells, but I also, welcome emails. So Lauren@7einvestments.com.
Okay. Well, thanks for sharing that. Again, you and Chris co-founded the two funds there. Do you have an underlying company, or 7E Investments is what you guys are?
7E is it's funny, we get this a lot. So it's C Corp, it's CWS Investments Inc., but our DBA is 7E. So Everyone knows this is 7E. And when we tried to make that shift to CWS, some of our older investors who had been with us for a while, like seasoned, I guess, veteran investors, were like, wait, you have a new offering? What's CWS? And we're like, oh gosh. Nope, let's back up. 7E, we're just going to stick with the 7E. So, yeah.
It's so tough to make changes. When Richard and I combined companies, I had switched from, it's called Bright Path, and now it's called American Note Buyers. And it was really funny to be like, I would never have thought this would have been, confusing. Yeah. But I guess I can see how it's confusing when you don't deal with it every single day. So I was like, okay.
Something so that, as investment fund managers, as what we do is so analytical and in the weeds. You're like, I'm getting hung up on the name right now.
Yeah.
You see that one coming.
Yeah.
So it took us a bit, but everything now is 7E.
Well, it makes sense. It's a name that has stuck for a while, so it makes sense to keep it that way. So, Lauren, it was awesome to get to know you during this podcast today. Hopefully we'll get to hang out a little bit more in the future and get to know each other.
Yeah.
Have some more fun conversations, but thanks for being on the podcast today. I really appreciate it. Lauren at 7einvestments.com. You can check out their website, 7einvestments.com. You can catch the video stream of this on the American Note Buyers YouTube channel. And I'm Justin Bogard with American Note Buyers. This is episode number 3 of season 6 on Be the Bank podcast. We'll catch you guys on the next episode. Bye, Lauren.
Bye. Thanks for having me.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.